At Ox Capital, we seek to own quality companies that can grow in 3 to 5 years' time and buy them at a cheap valuation. So that's core of what we do. However, we also have this risk management layer, which we can flexibly apply to try to reduce the downside of the portfolio. And the outcome is that the investor should have a smoother experience owning the product, as we can enjoy the upside with the good stocks we own if we do our job right, and also have a less of a drawdown or downside risk in the portfolio over the long term. And in doing so, capturing a good upside in the portfolio and reducing the downside, the long-term outcome should be favorable. And this is what we seek to do. So how do we do this? So we have been investing in these markets for a long time. I mean, over time, we realized that, once every few years, there can be a lot of volatility in the markets. It may be because of macro situations and the like. So what we've done is that we have actually have the experience to actually put in a framework to assess what is going on in the global economy and also in the regional economies, and then compare that picture based on our framework to what the narrative in the market is talking about. So alarm bells start to ring in our heads when our framework tells us a different picture compared to the market narrative, because that may suggest that people are positioned wrongly. I mean, there's a dislocation in asset prices. Certainly over the years, this framework has helped us to avoid some of the pitfalls in the markets. And in 2022, which was one of the most volatile years, right, in stock markets, the framework has actually helped us to achieve very good results in terms of protecting the downside in the portfolio, and that led to our outperformance last year, or helped our performance, certainly. So a little bit of detail as to how we actually do this. There's two elements. The first element is the quantitative element, which basically is a model that captures more than 1 million data points each time we run it. And what that model does is basically look at numbers and form sort of a quantitative bird's eye view of what the economic numbers look like for the major economies. And the principle behind that is quite simple, actually. It's actually about following the flow of money, because when money gets created, gets spent, it actually leads to economic activities. So we observe these data points in key economies like US, Europe, Japan, and China to see what is going on, in these economies. So that's the quantitative element of it. Of course, there's also a fundamental layer to this framework, and that is really about understanding the nuances of government policies, the nuances of monetary policies, reading, economic data that comes out in a more, qualitative way. And the outcome of using this qualitative and quantitative method of looking at the economy is that we can come to our own conclusion as to what is going on in the economy. And we use that to compare with what the market is talking about. For example, last year, we were actually early on, 2022, quite concerned with the global economic slowdown and inflation. But it was a time that actually, if you remember, beginning of last year, the market was actually quite exuberant, was actually quite happy, because we are past over COVID, the stimulus money has made its way into the economy, businesses were doing well, inflation is going up, but it wasn't too much of a problem. But we believed that inflation was going to be a problem, and in fact, if we look at the credit creation, it's already been slowing since second half of 2021. So we're actually quite concerned with the growth of the economy, and that allowed us to be more cautious in our approach to our portfolio construction. On top of that, I guess another example was that last year, a lot of people early on, a lot of market participants were very positive on computer chips, semiconductors, because as you may remember that there was a shortage of computer chips or mem chips for cars. There's not even, people can't even make cars, or company can't even produce cars because it's not enough, chips for them. So the semiconductor sector became a bit of a hiding place where people thought, yeah, there's a shortage, it's okay. But the awareness that, well, there's a credit slowdown already. Some indicators were showing weakness, certainly in the semiconductor space, in smartphones, and also in the PC side of things, made us actually quite cautious in that sector. Again, I mean, the story from the framework actually told us that, well, the story is not as rosy as the market narrative talks about when it related to, semiconductors in 2022. So we had a very light exposure to the sector and in fact hedged some of the risks away, which helped us to actually protect the downside risks as well. The risk management framework, it's a layer that we apply flexibly and also judiciously. The core of what we do is to pick quality companies that can grow and get stronger in many cases in the coming 3 to 5 years. But the application of the risk management layer allows us to actually reduce some of the downside in the markets, once in potentially every few years, which helps us to smooth out our returns. This concludes our thought leadership series. Thanks for watching. If you'd like to know more, please visit our website. Thank you.